First of all, China's rise is inevitable. No one can stop it. The United States cannot stop it. That's the mega trend. Secondly, this trade war launched by President Trump and his government against the whole world, including China, is the wrong war. And it's not constructive. It throws all the rules of the game out of the window. It damages the free trade. And while different countries need to come up with strategies, how do they want to deal with the United States in this manhandling of mankind, China has decided to rise up to the occasion and strongly defend the free trade. China will fight to the end, as the government has declared, and China has now imposed the retaliatory tariff up to 125%.
When Brazil redirected its mineral exports to China, the United States auto industry plunged into crisis. First, China's rise on the global stage is unstoppable. No one, not even the United States, can prevent it. That's the inevitable mega trend. Second, the trade war initiated by President Trump against much of the world, including China, was a strategic misstep, an unproductive battle. China chose to meet the challenge head-on, defending free trade with vigor. The Chinese government vowed to fight back and swiftly imposed retaliatory tariffs as high as 125% on United States goods entering China. As a result, electric vehicle prices soared and thousands of American workers lost their jobs. How will the United States recover from this disaster? Here's the deeper problem. Brazil, a critical supplier of lithium and nickel, vital for EV batteries, had long been a reliable resource for the United States. But after Washington slapped hefty tariffs on Brazilian goods, Brazil pivoted. They inked a covert agreement with China, sending their precious minerals for EV production straight to Beijing. With this new alliance, China, already the world's EV powerhouse, secured dominance over the raw materials needed for green tech innovation. Meanwhile, the United States, having alienated Brazil, now faces severe shortages in the materials needed to stay competitive in the EV industry. This shift has massive consequences. Brazil, controlling most of the global lithium and nickel supplies, has not only strengthened its hand but altered the EV playing field entirely. China capitalized immediately, tightening its grip on the electric vehicle empire while America lost ground. What drove Brazil's decision? Simple U.S. tariffs made Brazilian goods non-competitive. China, offering better deals with no tariffs, swooped in. In response, Brazil signed a billion-dollar mineral export agreement with China, cutting the U.S. out almost entirely. The outcome? U.S. electric vehicle plants are now scrambling, production lines slowing, prices ballooning, and workers being laid off. Production costs have surged. Gasoline prices, meanwhile, have spiked past $5 a gallon. This crisis is rippling through the entire U.S. economy, straining families and stifling industries. Consumers struggle with skyrocketing EV costs, while automakers face supply chain nightmares. While America stumbles, Europe steps up. Germany, France, and the UK ramp up EV initiatives, pulling further ahead. Meanwhile, China consolidates its leadership in EV manufacturing and green tech, leaving the US teetering on the edge of technological irrelevance. Tariffs intended to defend American interests backfired spectacularly. Instead of gaining strength, the United States triggered a financial earthquake.
The financial markets have had a few days to try to digest President Donald Trump's massive increase in tariffs. And so far, they're panicked. They're worried. They're afraid not just of higher prices, but a possible recession, with the investment bank Goldman Sachs saying that there's a 45% chance of a recession this year, even if some of those tariffs get pulled back. Right now, the White House is showing no signs of retreating. The core issue, in many respects, is the idea that the White House wants not just tariff cuts by other countries, they also want changes in those countries' taxation and regulatory codes. And doing that is going to take time. It's going to be hard to resolve this situation quickly. However, we've also seen that markets are so desperate for good news, and the situation is so sensitive, that a misleading report on social media that Trump was considering a 90-day pause instantly caused the stock market to recover somewhat on its daily losses. All of this points to the fact that the uncertainty is only mounting. we're seeing the fear spread into other parts of the economy as businesses and families are figuring out what this means for them, not just in terms of high prices, but in terms of slower growth and possible layoffs. As a result, the drama will only keep building until we get a clear signal from the White House in terms of what they plan to do to address the possible damage and also ensure that this is a policy that does more to help the United States than possibly hurt it.
In just one day, Wall Street lost $4 trillion. Tech giants, Apple, Nvidia, Tesla became the first casualties. The Nasdaq plunged 4%, one of its worst drops in years. Apple's stock tumbled 6.3%, erasing over $160 billion in value in a single day. Nvidia fell 7.8%, losing nearly $180 billion. Tesla crashed 9.2%, wiping out $125 billion from its valuation. Microsoft, Meta, and Google also suffered, shedding $350 billion combined. Analysts warned that if the panic deepened, a full-blown tech bear market could follow. The carnage didn't stop with tech. Airlines and hedge funds felt the blow too. Delta Airlines slashed profit forecasts by 50% amid rising fuel costs, causing its stock to nosedive 14%, the steepest fall in 5 years. American Airlines and United Airlines stocks sank by 11.2% and 9.8% respectively. As uncertainty mounted, investors fled. Major hedge funds like BlackRock, Vanguard, and Citadel dumped stocks at record speed, pulling $240 billion from the market in one day. The collapse triggered a chain reaction. Major banks like JP Chase, Goldman Sachs, and Bank of America each dropped more than 5% as recession fears spread. The S&P 500 sank 5.7%, the worst single-day loss since the 2020 pandemic crash. Retail wasn't spared either. Inflation from tariffs hit hard. Walmart lost 12%, shedding $56 billion in value, while Amazon tumbled 9% as consumer spending tightened. Even Bitcoin wasn't safe, plunging 5% to $42,000 with $200 billion erased from the crypto market overnight. Meanwhile, bond markets sent out clear distress signals, with the 10-year U.S. Treasury yield falling to 4.22%, a classic warning of an incoming recession. This wasn't just a market hiccup, it was a full-on economic confidence crisis. One wrong policy and $4 trillion evaporated overnight. At the same time, America's former best friend, Canada, also shifted allegiances. Canada, once a steadfast supplier of nearly 60% of U.S. crude oil, turned to China and India. These new partners were willing to pay higher prices. No tariffs, no political strings attached. Within just 3 weeks, 11.4 million barrels of oil were cut from the U.S. supply. Gas prices skyrocketed. Imagine driving through California and seeing $5.25 a gallon at the pump. U.S. refineries are now operating at just 71% capacity, compared to 89% only a month ago. It feels like a car running out of fuel on a lonely highway. And it's not just oil. Steel prices are up 22% in Michigan, and food prices are surging, vegetables and beef costs leaving consumers reeling. Canada, empowered by the Trans Mountain Expansion Project, no longer needs U.S. pipelines. Now they can independently transport up to 890,000 barrels a day, and they're sealing long-term deals with China and India. While the U.S. bickers in trade wars, Canada is cashing in. If this trend continues, Goldman Sachs predicts a 0.8% GDP contraction for the United States in the second quarter of 2025, possibly tipping the economy into a mild recession. And then came the European counterstrike. When Trump slapped a 20% tariff on EU goods, Europe didn't retaliate with wines or cars, they went after big tech. Meta, Google, Apple, America's crown jewels, became targets. The EU, mastering the power of regulation, tightened GDPR, launched digital taxes, and enforced sector-specific rules aimed squarely at AI, EVs, and battery sectors. Europe demanded transparency in algorithms, carbon dioxide tracking, and electric vehicle production, and bias-free artificial intelligence validation. Not with sanctions or bombs, but with legal fine print that left American CEOs sleepless. The EU's anti-coercion instrument further shut out American companies from bidding on European contracts. No missiles, no noise, just precision strikes through law. Big tech remains massive, but they're now playing by Europe's rules, not America's. Meanwhile, Trump's America First mantra suffered another blow when John Deere shifted some production to Mexico. Trump's furious response? A threat to slap a 200% tariff on any John Deere goods made south of the border, warning it would hurt American farmers and manufacturers. John Deere, a symbol of American agriculture, now finds itself at the center of the escalating trade chaos. Trump's move to threaten John Deere wasn't as simple as he thought. In fact, it could unleash unexpected consequences across the entire U.S. agricultural industry. To Trump, John Deere's decision to shift production abroad feels like a betrayal, a company deeply woven into America's identity now seeking profits elsewhere. So it wasn't a shock when Trump lashed out, vowing to impose a 200% tariff on any John Deere product manufactured in Mexico. But John Deere didn't back down. The company defended its move, insisting it was essential to stay competitive globally. While Trump tried to intimidate, John Deere demonstrated that American companies can and must expand internationally rather than be trapped by outdated protectionist policies. With U.S. production costs nearly double those in Mexico, John Deere had little choice. Emerging markets like Brazil, India, and China are hungry for agricultural machinery, and companies who don't expand risk being left behind. This conflict isn't just about tariffs and politics. It highlights a broader transformation underway in agriculture. Automation is taking over GPS-guided tractors. AI-driven harvesters and drone monitoring are no longer futuristic. They're standard. Yet Trump's policies seem rooted in an economy that no longer exists, widening the divide within the agricultural sector. John Deere is proving it's willing to endure political pressure to stay competitive. But will Trump adjust his approach? That remains uncertain. What is clear is that if John Deere wins this standoff, other American companies will likely follow, making it harder than ever to protect domestic manufacturing. Trump warned there would be consequences. Either companies like John Deere would be forced to abandon foreign plants, or they'd pay a tremendous tariff, making overseas production prohibitively expensive. Trump argued this would either prevent new foreign factories or drive investment into U.S. states like Michigan or South Carolina. He insisted, "We're not going to let that happen." This showdown between Trump and John Deere symbolizes more than a fight over tariffs. It reflects the growing pains of an economy evolving beyond old strategies. If Trump wins, protectionist controls will tighten. If John Deere prevails, a shift toward global expansion will reshape how U.S. businesses operate. But ultimately, it's American consumers who will bear the burden. Higher tariffs on agricultural equipment will push food prices up, raising living costs, especially for low-income families. This isn't just a corporate or political battle, it's a direct hit on the daily lives of millions of Americans. Meanwhile, U.S. farmers are growing increasingly anxious. China, their largest agricultural customer, spent over $24 billion last year on U.S. products like beef, corn, and soybeans. But that relationship is now collapsing. China just imposed a 125% tariff on U.S. agricultural goods, making them uncompetitive in a critical market. Europe retaliated too, slapping 18 billion euros worth of tariffs on U.S. goods, including cars, agricultural products, and consumer goods. As a result, car manufacturing costs in the U.S. surged by $18 billion in 2025, causing vehicle prices to rise sharply and sales to slump. For farmers, the impact is devastating. Unable to sell abroad, they face mounting losses. Nations like Brazil, New Zealand, and India have seized the opportunity, securing long-term contracts with China and other markets, leaving American farmers shut out. Soybean exports alone have crashed by 95%, falling from over 1.4 million tons to just 78,000 tons in the first 2 months of 2025. Farmers across Iowa and Illinois are watching international demand evaporate with little hope for recovery. The pork industry is collapsing too. China slapped a 170% tariff on U.S. pork, wiping out one of America's largest export markets. Orders have dried up, devastating millions of farming families. The seafood and dairy sectors aren't faring any better. Germany, France, and New Zealand are ramping up exports, offering lower prices and comparable quality, pushing U.S. products out of global markets. It's not just agriculture. Retailers and distributors are also struggling as shipments from China and Europe are delayed due to tariffs, worsening the U.S. supply chain crisis. Farmers have been told to be patient, but patience is wearing thin. Despite a multi-billion-dollar relief package from Washington, many farmers no longer trust the government. They don't want handouts. They need stable markets. Organizations like the National Farmers Union and the American Farm Bureau have called for urgent renegotiation of tariffs, but so far, little progress has been made. Meanwhile, Brazil, Europe, and South America are forging ahead. They've signed new long-term trade deals, cementing their dominance in global food, agriculture, and meat markets, further sidelining U.S. farmers. Global competitors are also investing heavily in infrastructure. New ports, expanded rail networks, and better export facilities allow them to deliver goods faster and cheaper than ever before. Brazil is flooding the market with low-cost soybeans. Australia and New Zealand are locking in lucrative dairy and meat contracts. India is undercutting U.S. cotton and rice exports with highly competitive prices. The U.S. agricultural sector is eroding rapidly. Competitors aren't just selling, they're securing loyal, long-term buyers. America, trapped in a trade war it can't seem to escape, is watching from the sidelines. Will U.S. farmers be able to fight back and reclaim their markets? Or has America permanently lost its agricultural edge to rising international players? Qatar has secured multi-billion-dollar contracts with European nations. And America? We're left watching gas prices rise while household budgets shrink. Canada and Qatar understood what Washington didn't. Success isn't just about resources, it's about long-term strategy and stable partnerships. While America imposes tariffs and picks trade fights, these smaller nations are locking in massive deals with Germany, Italy, and the Netherlands. And they're building full supply chains to back them up. Trump's 2017 tariffs on Canadian gas only pushed Canada into the arms of new buyers. Today, America is paying the price, with gas soaring to $6 per gallon and over 40,000 jobs lost in the energy sector. Texas and Louisiana, two Trump strongholds, are feeling the brunt. The United States still holds immense energy potential, but high extraction costs and lack of investment in innovation are dragging us down. Instead of modernizing, we're stuck defending an old playbook. Canada and Qatar, meanwhile, are racing ahead. Canada's LNG projects in British Columbia are booming. Qatar has ramped up gas production to 110 million tons annually, signing huge long-term deals with Europe. They're creating thousands of jobs and supercharging their economies, while America watches from the sidelines. And the shocks keep coming. China just dropped a bombshell, a 125% tariff on U.S. exports targeting cars, tech equipment, and semiconductor components, industries worth over $36 billion to the U.S. economy last year alone. Tesla immediately suspended shipments to China. John Deere lost $2 billion in just 48 hours. Supply chains are unraveling fast, and China's not done. They're reducing their U.S. bond holdings to their lowest levels in 15 years, signaling a clear move away from dollar dependence. Chinese state-owned banks have stopped issuing U.S. dollar credits, shifting to renminbi and euros instead. The world's second-largest economy is quietly building a future without the U.S. financial system. And it's not just China. U.S. allies are pulling away too. Canada, Saudi Arabia, Germany, they're forging independent trade strategies, cutting their reliance on the U.S. Saudi Arabia is even selling oil to China in renminbi, not dollars. The unipolar world America once dominated is fracturing fast. China isn't just fighting back, it's taking control. They're investing heavily in electric vehicles, securing critical minerals like lithium and cobalt from Canada. They're even building EV factories in Mexico to dodge U.S. tariffs altogether. Meanwhile, U.S. automakers like Ford and GM are struggling against a tidal wave of competition from Chinese brands like BYD and NIO. The American auto industry is facing an uncertain future, and China is no longer competing, it's winning. And on the global financial front, the dollar's grip is weakening. The Chinese yuan now accounts for more than 6% of global SWIFT transactions. China's rollout of the digital renminbi signals a major shift toward an alternative financial system. In a rapidly changing world, the U.S. is at risk of losing its financial dominance for the first time in a century. For more insights on the happenings in the political world and globally, don't forget to share, like, and subscribe to our channel.